Welcome to Talk Tickers. Today we are taking a really critical deep dive into a financial phenomenon that has just fundamentally reshaped global capital markets. I'm talking about the overwhelming and rapidly accelerating dominance of passive investment strategies, your index funds and ETFs.
And the shift, it's so much more than just a passing trend. It's like a structural re-engineering of how stocks are priced and how capital moves around the globe. For the last, 2 decades, passive has been celebrated, and rightly so, as this triumph of low cost and efficiency. It delivered incredible value to the average saver.
Exactly. But there's a serious debate bubbling up now, a growing one, especially among the heavyweights who've lived through a crisis or two. So our mission today is really to unpack both sides of that coin. Is passive investing the ultimate democratization of finance, or is it secretly creating this systemic fragility, these massive price distortions, and a structural risk that some are now, boldly calling the passive bubble?
I think we have to start with just the sheer scale of it, because the numbers, they're truly staggering. The growth of passive money is it's explosive. And it's driven mostly by the decade-long underperformance of a lot of highly paid active managers. That combined with a big regulatory push for lower fees.
Right. Let's just paint a picture of how fast this happened. Think back to 1995. Passive funds, your index trackers, your basic ETFs, they made up a tiny, minuscule 3% of all assets in U.S. equity funds.
Just 3%. Now jump forward with me to March 2020. That figure skyrocketed. It hit 48%. We are right at the tipping point where passive strategies command almost half of all U.S. equity capital. It's incredible.
And the momentum hasn't stopped. I mean, we saw global net inflows into passive investments total something like $1.1 trillion in 2024 alone. So where is all that money coming from?
Well, globally, the active equity funds in aggregate are seeing continuous outflows. The money is it's on a one-way street, straight into these mandated price-insensitive funds.
And that massive continuous flow has huge implications, doesn't it? Because passive money, it sort of concentrates risk by its very nature. We're seeing market concentration hit almost unprecedented levels.
Oh, absolutely. When you look at the S&P 500, which is the benchmark for almost everyone, what you're seeing isn't some diversified basket anymore. It's far more top-heavy.
How top-heavy are we talking?
The 7 largest stocks in that index now account for over 30% of its total value.
Wow. That's a huge chunk of market wealth just riding on a tiny handful of companies.
And that's where the core risk really comes into play, the one the critics are pointing to. The concern is that all these index fund inflows, they're governed by algorithms and math, not by the hard traditional work of fundamental security analysis. These funds are, in essence, mandated price-insensitive buyers. They have to buy what the index tells them to, whether the stock is cheap, expensive, or fundamentally broken.
I think we need to linger on that because one of the most vocal critics out there, Michael Burry, who famously predicted the 2008 housing crisis, he's drawn a pretty terrifying comparison here.
He has, yeah. Burry publicly compared index funds and ETFs to the collateralized debt obligations, the CDOs, from the housing crisis. Now, to be clear, he's not saying the assets are the same, but the structural similarity he points to is key. Investment decisions are driven by automated models, not by thousands of individual analysts doing their homework. And that creates this powerful, centralized herding effect.
When you put it like that, it sounds like we've traded thousands of diverse opinions for one giant homogeneous spreadsheet that's driving all the capital. But how did this philosophy even start? This wasn't the norm 50 years ago.
No, not at all. It truly started with John Bogle, who founded Vanguard back in 1975. He's the one who took this high-minded academic theory and made it practical. He created the first low-cost index funds that regular retail investors could actually buy.
And the theory he was applying came from the efficient market hypothesis, right? The idea that since all information is already in the stock price, trying to beat the market is, for most people, just a waste of time and money. So the best bet is just to own the market itself. It sounds so simple.
It is simple, but here's where you get this philosophical contradiction. The entire structure of passive investing relies completely on active investors doing the vital, expensive work of price discovery. If nobody researches stocks, how do you know if the price is right?
That sounds like a classic philosophical puzzle.
It is. And it was actually formalized in 1980 by 2 economists, Grossman and Stiglitz. It's known as the Grossman-Stiglitz paradox.
Okay, so let's break that down. What does the paradox actually say?
Well, the idea is that if stock prices perfectly reflected all available information, the ultimate goal of market efficiency, then there would be zero financial incentive for anyone to spend money gathering that information.
Right, because you couldn't profit from it. The price is already correct.
Exactly. But if nobody does any research, the prices would quickly become inaccurate and totally detached from reality. The system collapses. So passive investors are, you could say, free riders. They're benefiting from all the hard, expensive work that active managers do to set an accurate price.
And that's the real crux of the problem, isn't it? The more money that flows into these price-insensitive passive strategies, the less incentive there is for that crucial active research. We are kind of slowly starving the very mechanism that passive investing needs to survive.
And the performance pressure on active managers led to another issue, closet indexing. This is where portfolio managers, often because they're afraid of losing their jobs, they claim to be active, but their portfolio looks almost identical to the benchmark, like the S&P 500.
Which is terrible for investors because you're paying these high active management fees for what are basically passive-like returns. You're just overpaying for mediocrity.
Thankfully, investors do have a tool to spot this now. It's a metric called active share. It just measures the percentage of a fund's holdings that are different from its benchmark. A truly active fund should have an app share close to 100%.
And what's the red flag range? What should you look out for?
Generally, any portfolio with an active share somewhere between 20 and 60% is, well, it's likely a closet indexer. It's a really essential check if you think you're paying for active management.
Okay, let's pivot now to the real-world impact on the market today. If all this money is flowing in so mechanically, what is that actually doing to stock prices? The consensus seems to be that it biases the market toward overvaluation of those massive companies at the top.
Oh, absolutely. I mean, think about how these things work. They track value-weighted indexes. So that means when new capital flows into the index fund, it goes disproportionately into the largest stocks. It automatically buys more of them, no matter what their valuation is.
So if Apple is, say, 7% of the index, then 7 cents of every new dollar that flows into that fund is instantly mandated to buy Apple stock.
Yeah, precisely. And this relentless, non-fundamental demand, it just pushes the stock price higher and higher. And crucially, it leaves fewer active investors out there who are willing to step in and sell to offset that risk. The price has to rise to compensate the few remaining fundamental investors.
And beyond just the concentration, this mechanical flow creates these, predictable price movements, this thing called the index inclusion effect. When a company gets added to a major index, the funds have to buy the stock.
And that mandatory buying drives up the price. We've seen historical data, and it shows that companies added to the S&P 500 often see a price boost of 3 to 4% just on the news.
That predictability, that sounds like a gift to sophisticated traders, doesn't it?
It's a massive opportunity. Hedge funds, quantitative arbitrageurs, they exploit this index effect ruthlessly. They front-run the trades, they buy the stock before the index fund is forced to, knowing that mandatory demand is coming. Then they often turn around and sell it to the index fund at an inflated price, which means the index investor is buying a stock that's already been pumped up.
Wow. This really does sound like a system that's ripe for exploitation. And it seems the companies themselves are starting to notice. Listed companies are now, strategically using this demand from passive funds to their own advantage.
They are, and this is one of the most fascinating findings. Companies are increasingly using share-based compensation programs and issuing new stocks specifically to supply shares right when index funds are net buyers.
Okay, unpack share-based compensation for us. What does that mean in real terms?
It just means instead of paying their executives and employees only in cash, they pay them in company stock or options. So by issuing new stock for compensation, they can time the market perfectly to meet that relentless mandated demand from index funds. They're capitalizing on the flow.
That is a powerful incentive loop. The passive funds provide constant demand, and the companies are more than happy to supply new shares.
And look at the data. Aggregate share-based compensation for S&P 500 companies, it surged from about $36 billion in 2010 to $221 billion 13 years later. That's an annual increase of 15%. It clearly shows a strategic shift.
Right. I think I saw a Palantir board member actually tweeted about their listing change to the NASDAQ, and he explicitly said the move was intended to force billions in ETF buying. It's not even a secret anymore.
Exactly. And it's not just the core index funds causing these shifts. We also have to talk about the specialized passive strategies, like leveraged and inverse ETFs, the LETFs. These things, just by their design, they mechanically amplify market volatility.
How does that happen? They sound complicated.
Well, they promise daily returns that are, say, 2 or 3 times the index's movement or the inverse of it. But to do that, they have to rebalance every single day. And those trades always move in the same direction as the market just did.
So if the market shoots up, the fund is forced to buy even more at the end of the day to keep its leverage ratio.
Yes. They buy into strength and they sell into weakness. It just accelerates market swings. It's like a car where the accelerator is sticky. Once you start moving one way, you're forced to go faster. And this causes huge volume spikes right near the closing bell, which is where you see fragility.
Okay, so we've got concentration, predictable pricing, corporate exploitation, and now volatility amplification. This all leads to the critics' biggest concern, the crash mechanism. If a negative shock hits, a geopolitical crisis, a major bankruptcy, what happens when the tide turns from inflow to mass redemption?
This is the nightmare scenario. Because passive funds are required to stay fully invested, mass redemptions, say, from job losses in a recession, would force them to sell every single index component all at once.
They can't pick and choose. They have to sell the whole basket proportionally.
Correct. And when everyone is forced to sell the same basket at the same time, it could just destroy liquidity, especially in those largest, most overvalued stocks. Critics argue this could create a self-reinforcing downward spiral. Steep, rapid drops far beyond what fundamentals would justify.
That is a powerful and alarming argument.
Yeah.
But we have to stay balanced here. Passive dominance might not last forever. We need to look at the counter-argument, that the performance of active versus passive has historically been cyclical.
This is absolutely critical context, yes. Active management often comes back into favor, and it really shines during periods of market stress or when bubbles burst.
So what does the data show for when the market gets shaky?
Well, data covering the last 35 years shows that active managers actually outperformed passive funds in 22 out of 28 market corrections. That's a pretty strong track record of defensive performance. The average outperformance was just over 1% during those down periods.
And why does that happen? What gives them the edge when things turn sour?
Flexibility. Pure and simple. They can reduce their exposure to expensive, overvalued sectors. They can sell a stock completely. Passive funds are mandated to hold the very assets that are the most inflated. Active managers can just step away.
The perfect example of that has to be the 2000 dot-com crash. Active managers were able to limit the damage because they were, on average, underweight tech stocks compared to the S&P 500.
It was a conscious choice. They looked at those crazy valuations and decided the risk wasn't worth it, even if it meant underperforming for a bit during the mania. When that bubble burst, that calculated decision helped them massively outperform the trackers on the way down.
Which proves that active managers can mitigate the risks of a valuation bubble, something a passive fund, by its very definition, just cannot do.
And we're seeing adaptation now, even among the most sophisticated long-term indexers, the so-called bogleheads. They aren't ditching indexing, but they are actively managing their passive exposure.
How are they doing that?
They're rebalancing. They're moving away from these highly concentrated large-cap index funds and adding factor tilts. So, for example, adding more small-cap stocks or value stocks. They're trying to diversify away from the risk of those 7 mega caps dominating everything.
So they're essentially saying, I still believe in the low-cost approach, but I see that the current market cap index is vulnerable to a bubble, and I want to protect myself.
Exactly. It's a strategic response to the very fragility we've been talking about. They're accepting the efficiency of passive while mitigating the concentration risk.
This has been a fascinating deep dive. We've covered the undeniable benefits of low cost and simplicity right alongside the structural risks of concentration and mechanical market dynamics. As you synthesize this for your own strategy, we want to leave you with one critical question.
The one question that really ties it all together.
Look at your own portfolio, especially your large cap index funds, and ask yourself, how much of my current valuation is being driven by fundamental value? And how much is being driven by these mechanical price-insensitive index inflows?
Because understanding the true source of your returns, that's the key to accurately assessing your portfolio's risk. It's vulnerability. For when market sentiment eventually shifts from inflow, which is where we are now, to redemption pressure, which is an inevitable part of any market cycle. So, to summarize, the passive revolution delivered undeniable benefits in cost and simplicity, but it's also introduced structural risks. Risks related to extreme market concentration, the ability of companies to exploit mandated demand, and an increased market fragility that will absolutely be tested when volatility truly returns.
The future of investing, it's likely not an either choice. Active and passive strategies both have a critical role to play. But the informed investor has to look beyond just recent performance to manage the risks inherent in this new market structure.
And a final provocative thought for you to consider. If the majority of price setting is now driven by algorithms and mandatory flows, who will be left to correctly value a company like Apple during the next major credit crunch or earnings disappointment? Reflect on how that increasing reliance on non-fundamental flows might dramatically alter the path of the next market cycle and what that means for your own portfolio. As always, this deep dive is for informational purposes only and is not investment advice.